So good morning again, ladies and gentlemen. My background there, I think that was in Dubai. I took that picture.
Cool, cool.
You know, when we'll be able to travel to any place again. So did we all look at Reggae Jamaica Limited? Question. Let me see. So Kimoya, can you read the first section from please at the top? Kimoya?
Yes, sir. Give me a minute.
You can read from the screen, you know. Oh, you probably use, you have a print.
Yes, sir, but I wear glasses, so.
Oh, okay.
Okay. It says, during the financial year of 2018, the company attempted to stimulate sales and increase its profits by reducing selling prices.
Stop 1 minute. Just stop 1 minute. Thank you, Kimoya. So you recognize now the company has a strategy. They want to increase sales and increase profit. And the strategy is to reduce selling price. Continue, Kimoya.
Holding larger inventories and giving customers a longer credit period.
Just stop again. So they're expecting to have a larger inventory period. They're saying that since they're going to sell more, they want to have a larger inventory, and they're going to give customers a longer time to pay the debt. Go ahead. Go on.
All purchases and sales are on credit terms. The financial year end of the company is December 31st. And it's Reggae Limit.
Yeah, go ahead. Go ahead.
It says Reggae Jamaica Limited. Statement of comprehensive income for the year to December 31st.
Thank you.
And read the
No, Kimoya, you're good. Yeah.
Okay.
I'm going to Bella next. So we have the statement of comprehensive income. You have the balance sheet. Bella, can you read what is required?
Prepare a report to the managing director commenting on the performance of the company.
Thank you very much. Now, the moment you start reading, we know what the strategy is. They want to stimulate sales and increase profits by reducing selling price. So when we're looking at it, we need to look, bear that in mind. And bear in mind that they said they're going to keep all a larger inventory and grant customers a longer time to pay. So if you can look at sales, you see sales increasing. So you start looking at the figures as you go along in terms of analyzing. But we need facts to back up what our analysis, and therefore means we need to do vertical analysis and we need to do horizontal analysis. Okay, vertical analysis. Cheryl, you remember what we said about vertical analysis? How we do it? Let's say we deal with the income statement. Each item in the income statement is expressed as a percentage of. You remember, Kishana? Go ahead.
Sir, as a percentage of sales?
As a percentage, yeah, as sales revenue, yes. Go ahead. Cheryl, you were saying something?
Oh, you hearing me now?
Yes, I'm hearing you.
As a percentage of the base figure?
And the base figure is sales.
Yes, sir.
in terms of the income statement. So
Yes, sir.
in terms of the balance sheet, what would be the base figure? Kishana,
Sir, the total asset.
the total assets. This year, what else could we use?
Total asset plus the total liability figure, which will give us the total equity.
Say it again, what is yours?
The total asset and the total liability figures.
Look again, I'm putting the balance sheet there.
Or the total equity figure, total equity and liability.
Total equity and liability. So the total equity and liabilities are the total assets. So if we don't get total asset, but we can find total equity and liability, we still have the base, right? We still have the base, okay? So let's go to the vertical analysis. Okay? Here we go. Now, as we said yesterday, and we just said again, in terms of the income statement, the statement of comprehensive income, each item is expressed as a percentage of the sales figure. So the 3725 divided by 3725 times 100 over 1 is 100%. The same thing applies for 2018 5327 divided by 5327 is 100%. So we go next now to the cost of sales. So it's 2905 divided by 3725. I will multiply by 100 over 1, I will get 77.9%, 99%. The same thing for cost of sales, 4420 over 5327 times 100 over 1, and that gives us 82.97%. Okay? We do the same thing for the gross profit. It's expressed as a percentage of sales. And seeing as how we calculate the gross profit margin, if we're looking at profitability ratios, again, we need not calculate it. We can just go back to the vertical analysis and extract the gross profit margin from it. Or if we're looking at return on sales, we can just extract it from the vertical analysis. Now, I want you to, let me just go up. So if you notice, when we calculate it, we're looking at the figures, right? The gross profit margin was 22.01% in 2017. In 2018, it is 17.03%. Sales, the cost of sales has gone up. It's from 77.99%, and it is, as a percentage of sales, it is now 82.97%. If we look in terms of after-tax profit on sales, it was 13.42%. It has gone down now. It is 8.91%. Okay. Let me stop sharing this for 1 minute and go back to the question itself. Oh, here it is. Now, I need for you to take out your calculators and calculate for me the vertical analysis for 2017 and 2018 for property, plant, and equipment. Anybody that have an answer first, they can tell me.
So is it 73.14%?
73.14%?
Yes, sir.
For which year you're doing?
For 2017.
Okay. Thank you. Any figure for 2018?
66.12%.
0.12%. Let's do another one. But I need to hear from other persons. Everyone needs to be doing it. For inventories.
So from 2017, inventories is 11.36.
0.36%. Any figure for 2018, or anyone have a different figure?
2018 is 17.23%.
Anyone have a different figure? Thank you very much for those who participated. So someone had indicated that it is 73.14%. Someone indicated 11.36%. Now, so each figure is expressed as a percentage of total sales. So, total assets. So total assets divided by total assets is 100%, of course, for both years. Now, you might find that because we're rounding, one might need to round up or round down in order to balance it back to 100%, okay? We might need to round up or round down. And let me just highlight it again in another way. So each item is expressed as a percentage of total assets here, or if you want to say total equity and liabilities, the same thing figure we're talking about, okay? Because we are rounding up and down, the last figure that is there for ordinary share capital, that's rounded to ensure that everything adds up to 100%. So it is the 31.13% plus the 53.4 plus the 2.33 plus the 9.62 plus the 3.5 should give us 100%. The same thing applies for the prior year. The same thing applies for the asset year. The 73.1 for the 11.36, 9.27, 6.23, it should come back to 100%. So we're doing the vertical analysis. And remember what our strategy was. We're reducing selling price to increase sales and increase our profit. That's what we were doing. Okay? Is everyone clear on how we arrive at the figures?
Yes, sir.
Yes, sir.
Now, normally what I will do is have you write it on your printed document that you have, but which I would have printed and I'm sure everyone has. Everyone has a printed document? Let me ask.
Yes, sir.
No, sir, but I could get it printed.
So everyone doesn't have a printed document? Okay.
Of the question?
Of the question, yes.
Okay.
Okay. So I send this to you. But you have to agree to put it aside and attempt it and look at some of the answers. So you know exactly what to do. Because for your main project, you will have to do a similar analysis. Hopefully, the majority of the analysis will be done through Bloomberg, hopefully. Okay, and you don't have to pull out the calculator to do everything. So we said for the vertical analysis, when you come to the income statement, every item is expressed as a percentage of sales. When you go to the balance sheet, every item is expressed as a percentage of the total, whether total assets or total equity and liabilities. Okay? And since we have calculated here the gross profit margin, it's 22.01 and 70.03. When we go to calculate profitability ratios, we don't need to calculate the gross profit margin already because we can just extract it from the vertical analysis. Okay, we can extract it. Are there any questions in terms of, and I hope you're looking at the percentages. Like cash out bank, you notice, as a percentage of total asset, it is no less than 1%.
Sir, is it because they use most of the money to buy inventory to hold?
That could be a possibility. But they got in more money to, you know. You see they got a loan?
Oh, yes, sir.
So if they got a loan, what did they do with that money? You have to ask yourself then, if the cash position looks like that, what did they do with the money? Let's say, you're saying they purchased more inventory. Yes, that could be part of it. But that's a question we need to ask, what they did with the money, okay? So I'm going to horizontal analysis now.
Sir, one question.
Go ahead, Aki.
When answering questions relating to that, would we say that, would we answer saying it is possible that they had, spent it here, or would we have to say where they actually spent it?
It's based on the figures. You're going to assume and what is stated in the question, but you can definitely say it is this or that.
Or assumptions.
Yeah, there are certain things you can definitely say. You can definitely say that they receive more loan based on what is there. But the question is what they spend the money to. Remember, I say when we reduce cash, it can impact several things. And by looking at the figures, we can make an assessment and say, this is likely what they did with it. Okay?
Yes, sir.
So, but we're not there yet, you know. But I'm saying once we start analyzing the figures, we need to start interpret the figures at the same time. Okay? But we haven't started writing the report yet. Okay? So we go next now to the horizontal analysis. Here we go, the horizontal analysis. Okay? So the base year, or the base, I should say, is the prior year. So for sales, the base would be 2017 figure. So if you notice in terms of sales, it's 5,327 minus 3725. So it has increased. So we need to get how it has increased by. Okay. Now, so the increase works out to be So the increase divided by the base, which is 3725 times 100 over 1, gives us 43.01%. If you remember now, the strategy was to reduce selling price to increase sales. And see, sales is increasing. Okay? We also note that our cost of sales has increased, which is what we expect in terms of the cost of sales increasing since sales has increased. Okay? Now, in terms of advertising, it was 15. It went down to 10. It therefore means it has reduced by 5. So remember, it's a reduction now. So we know that when we calculate the percentage, we're going to put a minus sign because it's a reduction in the expense. So 5 divided by 50, that's 1/3. So it's 33.33%. So it has gone down by 1/3, advertising. Now, since we're increasing sales, one would expect operating expenses to increase, right? So it's 60 and moved to 77. So it has increased by 17. So 17 over 60 times 100 over 1 gives us 28.33%. So the prior year is the base figure. And when we look at interest now, it was 20, it is now 130. So it has increased by 110. So 110 divided by 20 times 100 over 1 gives us 550%. The profit before tax has decreased. It therefore means whatever percentage figure we get, it's going to be a minus. The same thing applies for taxation. It has decreased. So whatever figure we get is going to be a minus. Profit after tax has also decreased. So whatever figure we get, percentage figure, it is going to be a minus. Now, any questions?
Sir, how did you get the, how did you get the percentage figures?
So if we go for, let's go for advertising expense, right? It was 15 in 2017.
Yes, sir.
And now it is 10. The difference is 5. So it has reduced by 5.
Okay, sir, I got it. Thanks.
5 over 50 now. And since once it reduces, the percentage figure that we're going to get is a minus figure once there's a reduction, the item we're looking at, okay? So I'm going to stop sharing. I'm going to come back to it. So that's the income statement. Any other question? We're clear how we get the figure? So it's the prior year,
Yes, sir.
represent the base, and we'll find the difference. And the difference becomes the numerator. So that is on top. And if it has increased, it's a positive percentage. If it has reduced, it's a negative we're talking about. So let me stop sharing. Let me go back to the question now. Where's my question? Oh, here it is. Okay. Now, let me ask you a question. For property, plant, and equipment, from one year to the next, what do you expect to see under normal circumstances for property, plant, and equipment?
So it should be reducing because of depreciation.
It should be reducing because of depreciation, right? I want you to calculate what has happened in terms of property, plant, and equipment.
Sir, question.
Yes.
Wouldn't the PPE also be dependent on the stage of the business, the life cycle stage that it is in?
Yes, but remember we say all things being equal, what would normally you expect to see? If you're charging depreciation, we expect the value to go down, okay? That's what you normally expect, right?
Yes, sir.
Okay. So what I want you to do is now to calculate and tell me whether it's an increase or a decrease. To calculate the percentage. I want everyone to calculate the percentage.
It's an increase, sir.
Increase what percent?
8.94, yeah.
Anyone else with a different figure? I want you to calculate cash. Cash at bank and in hand.
It's a decrease.
It's a?
Decrease.
It's a decrease, yes. What?
97.3%.
97.3%?
Yes.
Anyone else with a different figure? Everyone has calculated? Oop, what figures you got?
97.25%.
97.25%?
Yes, sir. And that's a decrease.
Same here.
And that's a decrease?
Yes, sir.
I'm worried when we have a big difference like that. Yes, Samantha?
Oh, I was just gonna say negative 97.25. Well,
97.25. Check that 97.30 again then. If we have two. Anyone else get 97.30? Or 97.25? What is the figure?
I got
I got
97.25.
97.25.
It was 97.25, but I rounded up.
No.
No.
Okay.
97.25, okay?
It's 97.25.
Yeah.
So that is a decrease. No. You said for property, plant, and equipment, there's an increase of 8.94. Is that correct? That's what I heard they say, right? 8.94. Was that the figure?
Yes.
Yes? That's a key answer? Yes?
Yes, sir.
Okay. Let me just go back now to horizontal analysis. So we have 8.93. No. What is this telling you? What is this telling us? We have to start interpret now. The moment we see that. Bear in mind, remember what I said? Normally, what you expect to see, all things being equal, in terms of property, plant, and equipment, we're charging depreciation, and therefore means the value should be going down. The value has increased.
Sir, they buy more property, plants, and equipment.
They bought more property, plant, and equipment.
Yes, more investing.
Where did they get the money from?
The loan.
The loan.
The loan, more than likely, is the loan, right? So we have to start tie things up and put them together. That's what we have to start doing, okay? Now, inventory has increased to 82.74%. Why has inventory increased, you think?
so because they're holding larger inventories.
Yes, that was their policy. So it's consistent with their policy, right? Trade receivables, that's increased by 114%.
Sir, because they gave a longer period to pay.
They give customers a longer period to pay, yes. So we have to type back in and doing all of that now. So the money that we have, even though we got a loan, we might have used to purchase property, plant, and equipment. And even though we're selling more, remember now, we're purchasing more inventory and people are taking longer time to pay. So probably that explains why we don't have any cash. Now, in terms of share capital, it didn't move. The ordinary share capital didn't move. So there's no change in that. Whereas retained earnings increase from the profit that they made, but we see loans increase by over 566%. Now trade payables have increased by 65.05%. Is this a problem?
Sir, they're allowing for a longer period to pay, and they have less cash, so they can't pay on time.
So you were right when they said take it. Yeah, they're taking a longer time to pay because they have less cash. Yeah? But they're paying the government. Okay, right? So those are some of the things. So once we start calculating the percentage, we have to remember the strategy that the company was employing. That's why I said when we have to get a foundation and understand the company and know about before we can proceed to analyze the entity itself. So we can start interpret as we analyze. So are there any questions? Now, if you notice, since you don't have any question, while you think of the question, if you notice, the inventory figure for 2016 is given to us. Why do you think that is given? Anyone?
For comparative purposes.
Yeah, for comparative purposes. Yes, I need more than that though.
So would it be if we were supposed to calculate the inventory, the increase or decrease in inventory in 2017?
Inventory turnover, yes. Because remember, we need an average inventory figure, right? So if we're calculating inventory turnover in 2017, we'll need the 2016 figure. Because that's what we're calculating the inventory in 2018, we need 2018 figure and 2017 figure to get the average, okay? So that's why it is given to us. Okay? So, any more questions in terms of that? So you can see how it relates now to what we have been doing. We can start answering some of the questions in terms of by doing the vertical analysis and doing the horizontal analysis. It gives us a better picture when you put it in terms of percentage terms. Okay? Stop here, this. Now, for the horizontal analysis and vertical analysis, instead of what didn't have the question printed, I send that to you, okay? But for this section, you will need to write because I want you to know and remember how to calculate the figures, okay? For the vertical and the horizontal analysis, as long as we understand how to calculate one item in the vertical analysis, we know to calculate the same thing in terms of the horizontal analysis. Once we can calculate one item, we know to calculate all the items, okay? So, let me give you some time to get paper and pen if you don't have, because we'll be writing. And we're doing Reggae Limited. When I finish with Reggae Limited, you can attempt, well, you have to go over this, but at next week, Tuesday, what was it again? Elijah Limited. We'll do Elijah Limited. So you can attempt Elijah Limited before we'll do it next week, Tuesday. Given that I will be doing Reggae Limited, yeah? Everyone has paper and a pencil or a pen. Anyone need more time?
You can go ahead.
Yeah, go ahead. Thank you. So minds are like parachute. They only function when open. So we have to open our minds. Okay? No sense in jumping out of the plane and don't pull the parachute. It won't work. So for the profitability analysis, remember I said, since we have done the vertical analysis, and if you look back when you get it, you'll see that the gross profit margin is 22.01%, and for 2017 and 2018, 17.03%, right? So for the gross profit margin, we're talking about gross profit over the net sales figure, okay? Well, if you do the vertical analysis, we don't need to do this again, but you need to know how to calculate it. Even though we're not going to sit down and write an exam together physically, we'll be socially distancing, I think, still. And you will still have to calculate the answers and select the correct one, since we'll be doing multiple choice, okay?
Sir, finals is multiple choice?
Yes, it's MCQ. I don't think things going to change that we're going to have in a sit-down exam where you come in and write in an answer booklet. I don't think so. So I'm going to start preparing MCQs based on the lectures, what we did, and what we highlight as important for you to start reviewing. So when it comes to having exam, it should be a breeze for you. I can't see. Amanda, are you finished?
Long time, sir.
No, sorry, it's not Amanda, it's Bella. Bella, are you finished? Bella,
Yes, sir. You wait on me?
You pass it over to somebody else?
I remember Zidan knowing, sir.
Zidan. Oh, yes, it's Zidan. Zidan, are you finished?
Thank you very much.
It could never be me because me don't know long stuff.
Anyone still writing? Anyone still writing? So I can proceed then. Okay? So we're looking at profitability analysis, okay? So that is the gross profit over sales. We can also have the net profit over sales. So it's the after-tax profit over the sales figure. Now, as we calculate, we have to look at see what is happening. and just excuse me 1 minute. If you notice in terms of gross profit margin, it has decreased. If you notice in terms of the net profit margin, it has decreased also. Remember, what is the strategy? To reduce selling price and increase sales. From what we have seen in terms of the horizontal analysis, sales has increased. But in terms of the profitability, so far, we haven't seen any increase in terms of profitability.
Sir, you may move on.
Yeah, move on. Anyone still writing? Anyone still writing? Okay. So we're saying the net profit margin is decreasing. Okay? Oh, by the way, once you write profitability analysis, you don't need to write that heading again. I just wanted to know that we're continuing with profitability ratio when I write the heading again. So you don't have to write it once you write it once, okay? So return on total assets now. So it's the after-tax profit. The total asset is the base. Just stop writing 1 minute. So when we said the net profit margin or the gross profit margin, once we say gross profit is on top. If we say net profit margin, net profit is on top. When we say no, return on total assets, it therefore means return we're talking about is after-tax return. It's on top. So the base here is total assets. When we say in terms of net profit margin or the gross profit margin, the base is sales. The base is sales. When we're talking about return on total assets now, we're talking about the base being total assets. And if you notice, it is declining. You can go ahead and write.
Again, sir, you may move on.
Okay, so we're going to calculate one more ratio. And then
Wait, sir, I wasn't finished.
yeah. You can go ahead.
That go on.
So we're going to calculate.
Yes, sir, you can go ahead.
Okay, we're going to calculate next return on equity capital. So Khadija, what would be the base? Equity capital. Because just like we say return on total assets is the base. So if we say return on equity capital should be the base. Okay? So it's a profit attributable to ordinary shareholders. Don't write anything yet, okay? If there were preference shares, out of that after-tax profit, we'd have to take out first the profit that belongs to the preference shareholders. And the balance would belong to the ordinary shareholders. So it's profit attributable to ordinary shareholders. That's why we say it in that way. And remember, we say any reserve belongs to the ordinary shareholder. So in terms of equity capital, it is the share capital, ordinary share capital that is, plus the reserves, and that will give us the base. Now, if you notice, again, the return is what? Declining. So profitability for shareholders is declining in terms of return on equity capital. You can go ahead and write now. When you finish this, we are going to take a break, okay? So when we finish this, we're going to take a break, as I said, for 10 minutes. It should almost be 10 o'clock now, base. But we started 5 minutes. We gave people additional 5 minutes. So, and what I do, since you're coming from another class, well, the class is supposed to end at 5 minutes to the hour, I will begin at 10 minutes past the hour. Wait until 10 minutes past the hour, but please come by 10 minutes so we can begin. But we still have to cover the material. So those of you who have the question can look back in terms of the question and see, and the ordinary share capital plus the reserve, what it is in terms of the equity. And those who don't have the question, later on you can look at it. Okay?
Finish writing, sir.
Okay. Anyone else? Still writing? Anyone doing a summer school course? Can you just send an email to Elijah, ask him to do something for me? Can you send an email to Elijah and tell him the summer school course that you're doing, please? You can do it today. Come. You were saying, Bella, you're finished?
No, I was saying I'm doing a summer school course.
Yeah. So send Elijah the email. Please, when you send Elijah the email, name, ID number, the course code, and the name of the course that you're doing, okay? Make it easier for him to put the information.
Okay.
So,
Sir, who is that?
Elijah Green. Sorry, my apologies. I'm talking to the co-op accounting students who are doing summer program, not summer school students, okay? I'm talking
Okay.
to the registration, their main registration is summer, not summer school. So everybody in is whose group now? Akeem's group, except for one person. Who was it again? In Akeem's group that is in the club. Chantoy, Price, right, yes. So those are the persons I'm talking. So we can take a break now. Everyone is finished? Anyone see the writing? Okay. So the clock has been set for 10, a 10 minutes break, okay? So I'll see you in 10 minutes. We're ready to go again. That's the 10 minutes, okay? Feels like someone is missing, you know. Amanda, anybody missing from your group?
I'm going to check.
Zidane, anybody missing from your group? Akeem, anybody missing from your group?
So there's one person missing from my group.
Sir, everyone's here for me.
Go again, Zidane. Everyone is here for you. Yeah. And during the break, I tried to contact the business strategy lecturer. I didn't get him. I guess I have to wait until he finishes class later on to try and get him. But I tried again. I didn't get him, okay? But I'll continue trying.
Okay, sir. Appreciate it.
So we looked at profitability analysis. Oh, Amanda, who is the person missing from your group?
Abigail.
Abigail. Okay. Akeem?
Yes, sir. One person missing.
Who is the person?
Shantai.
Shantai. Shantai. Was Shantai here yesterday? Okay. Was she here yesterday? You remember, Akeem? So Shantai. Okay.
I think so.
So we're going next to the short-term solvency. We spoke about a short-term solvency already when I mentioned the inventory figure, so inventory turnover, right? What other short-term solvency ratio would we like to calculate? Should we be calculating? Anyone? Remember, the short-term solvency is the ability of the entity to pay its debts within the short term, within the next 12 months. So what type of ratios would we want?
What
current
type or
ratio?
which? Okay, yeah.
Current,
Which ratio, sir?
sorry.
Yes, Zidane, current rate. Who said?
No, sir. Ladies first.
Bella.
So current ratios.
Current ratio, yes. Anything else? The quicker asset test ratio. And bear in mind, they indicated that they're going to grant a longer period for people to pay. We would want to see the receivable collection period, how many days it is taking now they're giving the debtors to pay, okay? So we want to know that also, okay? So those are some of the ratios that we could be looking at. What did I do now? So this is where we're at. So in terms of short-term solvency, the current ratio, we're talking about current asset divided by current liability. And before you start writing, the current ratio and the quicker asset test ratio, when we calculate it, we add 2, 1. So when you calculate, we get 2.05, we put 2, 1. Okay, you can go ahead. So in 2017, it was 2.05 to 1. In 2018, it is 2.12 to 1. So there's a slight improvement. Ashley, you were supposed to go over the material. Do you have any
Yes,
questions?
sir. I've been going over.
You have any questions?
So far, no, sir.
Okay then. Okay.
So we're going through the short-term solvency. Could you tell us like the ideal ratios? Because I know that for current, the ideal, well, the best would be 2 to 1 and etc.
There is, when it's the idea, there's international benchmark. There's an international benchmark in terms of the current ratio. There's an international benchmark in terms of the quick asset test ratio. But these ratios will vary from industry to industry. So whereas the international benchmark, generally speaking, is 2 to 1, and for the current ratio, a 1 to 1, it can vary from industry to industry. Okay?
So does the industry benchmark now, would we have to find that?
If you're looking in the Caribbean, they don't give you industrial averages. So what you'll have to make a comparison with is a firm within the same industry. That's what you'd have to look at. But
Okay,
you
thank you.
really get information in terms of industry average. Okay? And bear in mind, there are certain ratios, like if we think in terms of the credit period, irrespective of what is happening in the overall economy, we have to look at the credit period that the entity itself grants. So if the entity grants 15 days, anything has to be in reference to that 15 days, as opposed to any international thing. Or it could be 30 days that they grant. And for some industries, it's 60 days that they grant a credit period. So it will have to be in reference to that. Okay? Are we finished with the current ratio? If we want to get a better picture now of liquidity, remember now in terms of our current assets, inventory is not a liquid asset, because when we sell it, we might have to, we're converting it to trade debtors, trade receivables, and then convert that into cash. So it's not that liquid. Therefore means we can take it out of our analysis and get a better position in terms of our short-term liquidity. Everyone is finished? Anyone still writing? No? So we're minusing our closing stock, in this case, from our current assets, and then divide by the same current liabilities. And again, as I said, whatever figure we get, we say to 1. If we were, let's say, inventory turnover, we'll express it in terms of times. And here, there's a slight deterioration from 1.18 to 1.04. We're going next to the, if I remember correctly, we're going next to the inventory turnover. And as soon as you're finished, let's see now, Samantha, you can tell us, as soon as you're finished writing the quick ratio, tell us the equation that you remember for the inventory turnover. If you can't remember Soman, you have to assist her.
Sir, hold on. Sir, I'm here. Okay, so it's cost of goods sold divided by inventory, right? Is that it?
Yes.
Sir, average.
You want to modify the inventory? Somebody was helping you.
The average inventory?
The average inventory, yes.
Mm-hmm.
Average inventory. Okay. Zidane, are you finished?
Yes, sir.
Anyone is still writing?
Still writing, sir.
Okay. Whenever you're finished, you let me know, yeah?
Okay. I'm finished now.
Finished? Anyone else still writing? Anyone else? So in terms of the inventory turnover, we say since it's a turnover ratio, we express in times. So whatever figure we get, so in terms of 2017, the figure we have is 4.06. So we said 4.06 times. In terms of 2018, it's 4.28 times. Would you say it's improving or is it deteriorating based on what is there before you start writing?
It's improving.
It's improving because we're buying and selling at a faster rate, right? It was 4.06, now it's 4.28 times. So
Yeah.
it's improving. And what I want you to do later on, when you're reviewing the question, you calculate the average inventory for 2017 and for 2018. When for 2017, we're using the 2017 inventory figure and the 2016 inventory figure to calculate the average inventory, okay? Remember I said, once you write the heading, we don't have to write it each time. It's just for you, I'm putting here so you know that I'm still under that same heading. So once you write short-term solvency from the beginning, when we calculate the current ratio, you need not write it again. So we're gonna look next at how much days our trade debtors are taking to pay us. And we always make the assumption it's 365 days in the year, okay? Are we ready?
Yes, sir.
Anyone else writing? Anyone else writing? Okay, so the receivable collection period. Sometimes it's going to be difficult for you to determine what is the credit sales figure unless it is given to you. In this particular case, they said our sales is for credit, unless they separate it in terms of cash and credit. Unlike that, they're going to do that. You have to make a certain assumption. So you probably can calculate this particular ratio if you have not given adequate information. Okay? Well, in this case, we have adequate information to calculate it. So we're expressing it in terms of days. We're expressing in terms of days. Now, for 2017, it's 58.4 days, whereas 2018, it's 87.57 days. Now, our trade debtors are taking a longer time to pay us. Under normal circumstances, we would say that is a bad thing. But given we know what the strategy is, they have indicated that they want to give people a longer time to pay. So this could explain why the number of days that our trade debtors are taking to pay is taking much longer. That could explain why, okay? And if you go, well, I won't go back to it. I'll just say it. In terms of our inventory turnover, since they reduced selling price, they're expecting to sell in more. So they're expecting the turnover to be much faster, and the turnover is faster. So I think we get a picture now in terms of the short-term solvency or liquidity of the entity. Based on what is there, it's not bad. We look next in terms of the long-term solvency, So from now on, I'm going to begin at 10 minutes. I'm asking everyone to be here at 10 minutes afterward to give enough people time. And I will try to finish at 10 minutes to the hour instead of 5 minutes to the hour. Some people have lectures right after, so we can even get a 5 minutes break and eat something before you go to your lunch time class. Those persons who are absent today, can you reach out and find out why they are not at class? The group leaders. And
I mean, everyone here is present from here.
Say it again, Zidane.
Isn't everyone here present for my group? So.
For your group? No, so you're okay. I'm talking about, it was Amanda, I think that says someone is missing too. For the group leaders that have someone missing, find out. You know, this is 2019. For 2018, 2019, what was I teaching? Oh, it's financial statement analysis I was teaching before I went on leave. And I said to students, I need 100% pass rate in every stream, 100% pass rate. And people say it is not possible. They feel it's not possible. But I've had 100% pass rate in classes during the regular semester, separate and apart from summer. And I'm saying we can have it if everyone attends class and they pay attention and they do exactly what I say. We can have the 100% pass rate. And we had a 100% pass rate in 2 streams. It's just 1 stream, we never had 100% pass rate. And the person didn't come to class. So it is possible for everyone attending this course to pass. If you listen exactly what I say and you attend, you shouldn't have a problem passing this course. As a matter of fact, it shouldn't be a question of whether you pass or not. The question should be, what is your grade? That should be the question, but the thought of failing shouldn't be a question. Everyone finished? Anyone still writing? Zidane, you're okay?
Yes, sir, I'm quite fine.
I feel some people still writing, so let me give another minute. And bear in mind, I said, this is just like a class. I can't see everybody's face and see what they're writing. So I would normally ask in class, and I'm asking the same thing here. I wait until everyone is finished before I move on. Is anyone still writing? No? So we can move on. So we go next to long-term solvency. So this is short-term solvency. That is short-term solvency, okay? So we have looked at short-term solvency. We're going next to long-term solvency. So we're looking at the ability of the debt to pay, the entity to pay its debts after a 12-month period. So we're talking about non-current liabilities. We're talking about non-current liabilities. And if you remember, in terms of this particular entity, the non-current liability was the long-term loan. That was the non-current liability. So we're looking at its ability to pay its debt. And of course, when you look in the income statement, there's interest. So we have to look at ensure that the entity is earning sufficient profit that can cover the interest, okay? So we're looking at long-term solvency now. So we're looking at debt to equity. So in 2017, remember it was 150. And we're dividing that by the equity capital. So it's 2.76%. It has gone to 18.16%. And why has it increased? Remember, as we go along, why has it increased? Kishana, why do you think it has increased, the debt to equity ratio? Kishana McCain.
Sir?
Yes, I'm asking, why do you think it has increased?
Not sure, sir.
Dacia? I haven't heard it from morning. Dacia?
Sir, when they took on that loan, they had they added another debt to their hands, and then
right, so
they
they
didn't
don't
have enough.
The loan has increased. Thank you very much. So as we calculated, we have to remember the figures, and we're trying to explain it as we go along. Okay?
Sir, Shanta is having internet problems.
Okay. So somebody will have to share the information and tell her exactly what to do in terms of the calculation. And please let her know next week we're doing Elijah. We're not going to finish this question at don't because I'm finishing at 10 minutes to the hour. Not going to finish this question, but tomorrow we'll finish this question. Gabriela, you finished?
Yes, sir.
Anyone still writing? Anyone still writing? Do not be afraid to say that you're still writing if you're still writing. So that's long-term debt to equity. We need to get the times interest earned. Ashley, you have a copy of the question? Ashley? Oshina, you have a copy of the question? Yes, Ashley, you have a copy of the question? Can you look at it and tell me what is the profit before interest and taxes? And tell us how you would arrive at the profit figure before interest and taxes. Anyone with a question can tell me? Mute your mic, Ashley.
Here for 2017 it's 745, and for 2018 it's 820.
Thank you very much. And how did they arrive at the figures? You tell us?
Well, sir, it was
Who is speaking?
clearly Anolia. It was clearly defined in the income statement, but I guess it would be the profit before you add the interest expense and before you add the taxation, but it was clearly defined.
Okay. So once you have the profit before tax, you just add the interest to get the profit before interest and taxation. And that is divided by the interest figure. Don't write anything yet. And that is divided by the interest figure. Now, remember when we look the turnover, we express in terms of times. This tell you right away is the times. So times interest earned. So it is 37.25 times. It has gone down in 2018 to 6.31 times. What would anyone say about this? What would you say about this? Is it still okay? Or is it bad? Anyone? Oshina, we haven't heard from you, Martin. What do you think?
Sorry, I don't think it's okay, but because I'm writing.
Oh, you're writing. Okay.
Sir, I'm thinking that based on the fact that the interest expense is increasing, it would be bad.
Should be bad. Anything else?
But the profit before interest and taxation is also increasing. So that's good. So I don't know.
So the higher the times interest earned, in my opinion, the less likely it is that the organization or company will fail as a result of the profits declining. So the lower the times interest earned, and in this case it has decreased significantly, that is a bad sign.
Okay. True. Why do you think it has decreased significantly? Is it one factor or is it a combination of factors?
Sir, would it be in regards to the interest expense, being that the interest expense increased gradually in 2018 as when compared to 2017?
Yeah, well, why the interest expense increase?
Because of the
The
loan.
loan that they took out.
Loan. So it has increased. Hasn't the profitability also, in a sense, decreased? The overall profitability of the entity. But in this particular case, the profit before interest and taxes has increased. It therefore means the main reason why is because we have obtained the additional loan. Who had said it? No, who was it? My friend from it was better, I think had said, the higher it is, the better, and that's correct. It's decreasing now, and it has decreased significantly, so that's not good. But at the same time, it is still able to cover the interest expense by 6 times at least. Okay, it is still able to cover it, but it is certainly not good. Okay, Bella, you wanted to say something else? You were saying something else?
No, sir.
Okay. Okay. So that is in terms of the times interest earned. We'll write a report. You're writing a report. That's what the question asks. You know? So in writing a report now, we're taking into consideration the vertical analysis and the horizontal analysis and the ratios that we calculated to write the report. So the report is addressed to the managing director and it's from the accountant. And today's date is July the 14th, 2020. And the subject is the financial performance of Reggae Jamaica Limited for the financial year ended December 31, 2018. So that is how the report is going to be written. What I want you to do, because we're going to continue tomorrow in terms of writing the report. I want you to draft some things that you think should be in the report. And tomorrow we'll have a discussion about the items to be in the report. So you're not only taking into consideration the ratios that we calculated, all the ratios we calculated, right? You're taking into consideration also the vertical analysis and the horizontal analysis. And you're putting that against the background of the strategy that the entity is employing. And you want to see whether or not the strategy that they've employed is actually achieving the results, the desired results that they want. That's what you're looking at and reporting to the managing director accordingly on that. Okay? Are we finished writing this?
No, sir. No, sir.
if we're going to be writing in exam booklets, I would tell you that you need to start this on a new page.
Sir, I'm finished now.
Thank you very much. Anyone else still writing? Even though it's a multiple choice, please remember, I can ask questions, give you the figures and ask questions of you to interpret the figures and selecting the appropriate answer in terms of the analysis. So I can still ask you, instead of writing, you do the analysis and tell me what is the appropriate answer. So I want you to look back at the vertical analysis, horizontal analysis. I will send you that this evening. I know you have classes going on. I send you that this evening so you can look back tonight then and come up with items to put in the report to the managing director. I said that end at 10 minutes to the hour. It's almost 10 minutes to the hour. Anyone still writing? No? So